Good morning, everyone. Thank you for joining this NatWest session, where we will be reflecting on the impact of COVID-19 on foreign exchange risk management. Your speakers today are myself. My name is Mark O'Gorman. I head our corporate risk advisory business within NatWest. We also have Tim Jamieson, who heads our UK large corporate foreign exchange sales business. Luke Hasham-Smith, who sits within our corporate financing and risk solutions business. And we're very pleased and grateful today to welcome two of our UK customers. So we have Rob McAnally. Rob is the Group Treasurer of Associated British Foods, the diversified international food, ingredients and retail business, which includes within its portfolio the Primark business. We also have Phil Maton, Head of Risk at Liberty Global, the multinational telecoms business, which includes a number of well-known consumer brands, including Virgin Media. With the help of Tim, Luke, Rob and Phil, we will be sharing our anecdotal and personal experiences on rebalancing foreign exchange hedges in exceptional uncertainty, managing illiquidity in the markets alongside your own cash flow considerations, dealing with increased execution costs, as well as the practical challenge of remote working. During the session, if you have any questions, you can use the Q&A tab at the bottom of your screen, and we will try to answer those as we go through. There will also be a few polling questions. Again, you have a polls tab at the bottom of your screen where you can reflect, and we will summarise the answers during the discussion. The session will be recorded, and a recording will be available on the event platform. So without further ado, I will pass across to Tim Jamieson.
Thanks, Mark, and welcome everyone. Hopefully your commute to this year's conference was slightly less onerous than last year's. During the first part of this three-part session, we'll be looking at how corporates reacted to the dual threat of liquidity and cash flow uncertainty in respect to FX risk management brought on by the fallout of COVID. I'm very lucky to be joined by Rob McAnally, who will be sharing his experiences and learnings from the past 6 months, as well as commenting on the first of our poll questions, which should now be live on everyone's poll tab below. Rob, before we discuss in more detail the risk management reaction function of corporates over the last few months, could you just give us a sense of what it's been like being a treasurer of such a diverse group of companies during this challenging time?
No, sure, Tim. So as already been stated, ABF is quite a diverse group of businesses. So we have grocery, sugar, agriculture, ingredients, and obviously retail through Primark. And we've got operations in 52 countries around the world, and we sell into way more than 100. So the impact of COVID, as you can probably imagine, was quite different across our divisional businesses. We had retail, in which Primark's portfolio of stores, their estate, was completely closed on March the 22nd and was shut for 6 to 8 weeks, depending on which country you'd be talking about. But we then obviously had also the grocery businesses, and we had a mixture of those in different countries around the world. But those grocery businesses typically sell into either the food service industry or indeed into retail. So for those businesses that were selling into food service, they saw a distinct drop off in sales as a result of basically the world going into lockdown. As far as the grocery businesses selling into the retail was concerned, things were flying off the shelves. So inventory just became non-existent, and they had to actually operate their plants at in some instances greater 100% capacity to actually cope with the demand. So it was a whole host of things, and we've got one of the biggest yeast businesses in the world, where we're operating in, I think it's something like 26 countries, and again we sell into way more than that. And you couldn't buy yeast in many of the retail stores because people started home baking. So it is quite a complex sort of dynamic in which we were attempting to manage, and certainly the risk management aspects of that. You had to understand each of the businesses to then be able to help those businesses rethink what they were doing in reaction to the impact of COVID-19.
Yeah, thanks, Rob. I mean, clearly, as you say, some very diverse risks emerging for corporates sort of across the sphere. I mean, from our point of view, speaking to our corporate customers, I think there were some pretty consistent themes emerging, particularly when it came to the FX risk management piece in the context of COVID. I mean, as I'm sure everyone in this session will appreciate, cash flow forecasting became nigh on impossible for many corporates as both demand and supply side uncertainty hit businesses. Secondly, for corporates that had existing risk management policies in place, they very quickly found themselves with a mismatch between the hedge and the underlying economics they were looking to manage. And all of this uncertainty was really accompanied by really large moves in currencies. And this meant that sort of alongside the sort of cash flow uncertainty and liquidity uncertainty, they either had hedges that were very deeply in the money or very out of the money. So what was the corporate reaction function to this? Well, in the first instance, BAU FX policy was amended to align with the new normal cash flow forecasting. And this meant in some cases FX risk management was scaled back or halted, both to protect from overhedging, but also to preserve operational capacity as everyone shifted to working from home. And this is something we'll talk about in a bit more detail later. Hedging tenors were shortened. We saw about 50% fall in hedging out between 6 and 12 months, and about a quarter drop out to 6 months. Interestingly, where we would have historically expected to see FX options used as a substitute for forwards in times of market stress and uncertainty, the out premium outlay became very quickly too prohibitive for most liquidity constrained businesses. For example, the sterling put out to 6 months nearly tripled in cost over the space of a few days. Once the BAU activities were addressed, focus very quickly turned to the existing hedge back books of most corporates. And as I mentioned at the start, given the moves in currencies, this meant that there were sort of broadly two camps. For those with out-of-the-money hedges, typically sellers of dollars, they faced a tough choice as they were primarily constrained by three factors. First was the pretty ubiquitous cash flow forecasting problems we saw across the corporate sector. Secondly was credit line availability, as existing hedges used up a large portion of their available lines across their banking group. And this was important because it limited their ability to roll hedges into the future. And third, the available liquidity for settling expiring trades was also limited. Now, however, they did have the benefit of positive funding rebates from banks if they sought to exit the hedges early. Now, this idea of funding benefit or charge associated with derivatives might be something that not everyone in the session is familiar with, so I'm just going to spend a second just talking about it. When a trade moves out of the money to the corporate, the bank is effectively providing an interest-free loan, and as such, closing it out benefits the bank's balance sheet, hence why a rebate might be paid. Conversely, for hedges that are in the money to corporates, they're effective in interest-free loan to the bank, and as such, closing them out will typically attract a funding charge, as banks must then replace this source of funding at their own prevailing borrowing rate. So in the second camp were those with in-the-money hedges who faced sort of a slightly easier decision to take. Some did nothing, preferring to let the hedges expire in the money and run the market risk up until settlement. And this typically happened where there was no internal consensus of the business or operational capacity meant that they didn't have the bandwidth to address. Some companies rolled the in-the-money hedges to a future point where they were more confident of cash flows. And this attracted a positive funding benefit, as I outlined earlier, as they effectively extended the loan tenor they were providing to the bank. Some businesses used the hedges as the emergency source of cash, closing them out and realizing the positive liquidity benefits. However, this did attract a funding charge. Others closed out the hedges, but left the settlement at the original maturity date, thus realizing the cash at a future point, but removing market risk, addressing potential overhedging as the underlying disappeared, but also avoided the punitive funding charges because the hedges were left at final maturity. At this point, I'd like to bring Rob back in to share his approach to the FX risk management during this time, particularly in respect to Primark.
So I think across the group, actually, Tim, you spoke about, I think, cash flow forecasting, you spoke about time horizon for hedging, and some of the revisions to hedging policy that were taking place. I think it's fair to say that actually we didn't change our hedging policy because actually across our group, businesses actually look at their particular business, the requirements of their business, their ability to forecast with a highly probable elements of their forecast to determine what they're going to hedge and when they're going to hedge it. It depends on a whole host of things, including the margins of their business, the nature of the peers in their marketplace and what their peers do, volatility on input costs and cyclicality of raw materials on input costs and this sort of thing. So we're hedging both input and also sales, and obviously currency is a key part of that. What we didn't do is change the policy. What we did do is make sure that the businesses had a better sense or an up-to-date understanding about the likely impact that COVID was having on their business. And it comes back to whether they were selling into the food service industry, whether they were selling to retail, or one of our big businesses, sugar. What impact the closure of pubs, restaurants, entertainment industry was having on the consumption of sugar. So by virtue of actually addressing it with each of our divisional businesses, we were able to actually determine whether or not there was anything we needed to do to the existing portfolio of derivatives, and then on an ongoing basis as to whether or not the highly probable element of their forecasts would have to be reduced in order to be able to ensure that we get hedge accounting, because that's one of the prerequisites within our organisation in terms of taking out derivatives. Whether they be options, futures, FX derivatives, etc. And so we were able to, I think cash is always king as far as treasurers are concerned. Cash probably for companies with relatively conservative balance sheets maybe wasn't quite as high on the priority list as it should have been. But with Primark's estate of stores being shut, we were potentially losing £650 million a month. And clearly that was going to have a very, very detrimental impact on our liquidity. So very, very rapidly, we spooled up businesses' abilities to be able to cash flow forecast on a short-term basis. So we had a rolling 12-week cash flow forecast implemented here, which all of our businesses have contributed to, and we continue to do to this day. And that made a massive difference to the visibility as far as liquidity was concerned. One of the other things that we obviously wanted to do is see whether or not our portfolio of derivatives in each of our businesses was reflective of the prevailing trading circumstances. In Primark's case, there were a number of forecast exposures that we had hedged going out, on average about 6 months, and it was recognised that actually those were unlikely to occur as a result of the closure of the stores and the impact on sales. And so quite rapidly, we were getting our Treasury colleagues in Primark to come up with the profile of the hedges that they needed going forwards based upon the updated forecast analysis. And it was in light of that we decided to essentially, what we wanted to do was unwind a block of FX trades that we had in place. But in discussing this with NatWest, we realized the most cost-effective way to do so would just be to put reversing trades in place, allow the trades to mature, and effectively receive the cash at the point at which the trades had originally been put in place for. The reason behind that, and it's something that Tim alluded to just now, was because when we looked at the cost of unwinding it immediately, there were various costs built into it, but there was likely to be I think it was £435,000 hit to the actual mark-to-market value at that time. So rather than incur that hit, we decided that actually we were just going to let them run out. So we took the profit, because it was actually a gain and a reasonably sizable one for that block of trades in this financial year, because our financial year has just ended mid-September, and then the cash will occur as those trades actually expire. So that's something that we managed to do fairly rapidly. I guess across the group, the exposures as far as FX were concerned were not as large as that, but there was a repositioning of our derivatives book across the business, but not particularly significant actually.
I think one question that's just been asked, and I think I was sort of going to ask it as well, is how did you sort of settle on a 12-week cash flow forecast when you were talking to your various businesses? Did you try and go further out, or were you sort of just keen to look at the next few months?
Yeah, I mean, it's a very valid question actually, Tim. We do have a certain basic cash flow forecasting mechanism in place, but I think if you try to get the businesses to actually go out much further, then the veracity of the information that you were being provided would be that much weaker. And in the sort of if you like, the eye of the storm, which was COVID and basically the world being shut down, I sort of liken it to the lights just going off, country by country. It became impractical to ask the businesses to go out much beyond 12 weeks. And what we did is we had an evolution of that 12-week cash flow forecasting profile where we looked at the accuracy of it and also the evolution of what the outcome looked like, aligned to a longer dated but more, I guess, rough and ready cash flow forecast. And actually, it was quite interesting to see the accuracy level of that 12-week forecast becoming more and more accurate the more the businesses got used to doing it.
Yeah, I think that's interesting. I mean, the poll results have just come in, and there's a clear bias towards sort of amending the amount hedged. I think that's probably not a surprise. I mean, do you think going forward for you, while sort of COVID continues to be an issue, that you'll look to hedge a lower amount?
I think it comes back to the business's ability to assign from in accounting parlance, a highly probable nature to their forecast exposures. So if they're looking at their, say, 6 or 12-month forecast exposures, whether it be on input cost or output sales, and they continue to be able to say that there's a high degree of predictability, then it would be unlikely that we would ask them to aim off. But again, it depends upon the sector you're operating in, the competitive tensions, etc., etc. So I wouldn't say that we are deliberately aiming off. It comes down to a business by business case in ABF in the ABF world, and that's because we have so many different businesses in so many different sectors. So there isn't a one size fits all.
Yeah, I think that's interesting. I mean, I think for us, there's probably been four areas of feedback in terms of how FX policy might evolve going forward in sort of response to COVID. I mean, clearly some hedging tenors and hedging percentages are probably likely to be more flexible. So previously, where corporates have had a very strict band of hedging depending on tenors, we're seeing a greater tolerance to Treasury teams operating outside of those, particularly in the short term. I think we are starting to see a shift in sort of, I guess, product selection when thinking about FX hedging, to more IFRS 9 compliant FX options, mainly geared towards reducing the risk of over hedging. I think faster decision making is clearly going to be imperative, and I think this sort of idea of controlled discretion down to Treasury teams is going to be important. So outlining maybe a more streamlined approach to taking decisions in sort of moments of large market volatility. And I think finally, one that we sort of found quite surprising was, it sounds quite simple, but most corporates don't have a stated policy of what to do with their existing hedges. So going into COVID, much like a lot of businesses found that they needed to do something with their back book, but it's outside sort of any stated Treasury policy, and so the decision-making process around doing something with it took a lot longer. I mean, on that last point, what was it like for you working through that kind of concept of sort of amending the trades that you already had on your books?
Well, and that's a really interesting one, actually, because within our Treasury policies, there is actually a specific section on ongoing management of your existing derivative positions, and it's something where it's incumbent upon the individuals who within each of the businesses who are requesting those trades to be put in place to ensure that they're managing them on an ongoing basis. Because I think the one thing that you can actually say for certain in this world is that tomorrow is not going to be what you thought it was going to be, and therefore, for each of our businesses, the trades that you might have put in place on a particular day might not be exactly the kind of hedge that you wanted when you project forwards. And so there is as I say, there is a requirement on each of our businesses and the risk managers within those businesses to be able to manage that existing derivatives book. And therefore, it wasn't difficult for us to address this particular question. Clearly, as I've already said, the different businesses around the globe within ABF and the sectors they operate in, you're having to apply a different lens for each of those businesses because there very much isn't one size fits all. But it's that flexibility in the approach, I think, which is important. I think one of the other things you also spoke about was options. And in a session earlier on this week, an ACT session, I was asked about the use of options. And I think, none of us have perfect hindsight goggles. And I was asked if I was aware of impending COVID, what would I have done to change the hedging strategy for the group? And I think the answer is A, I don't have that foresight, and B, I think the use of options, which obviously have asymmetric payoffs, they have their place in anybody's tool set for managing risk, but you do it depending upon prevailing market circumstances. So if the options fit the profile that you want and they're not inordinately expensive to the point that you made earlier, Tim, then it's something that one might use, and they would have been a perfect fit for COVID if you knew that it was going to happen, but you just don't know. And so we won't be changing our hedging policy just because there might be the risk of some more of these sort of dramatic situations occurring within the economy. We already have the ability to use options, but we only use them in the appropriate circumstances.
Great. Well, Rob, thank you very much for that. That was hugely insightful. And Rob's going to be staying with us to answer any questions towards the end of the session. I'm now going to hand over to Luke, who will be taking us through the second part of this workshop.
Okay. Thanks, Tim. So the next section is on execution spreads. I'm very pleased to be joined by Phil, who has had to do a lot in the last 6 months, and that was in the pipeline ahead of COVID, and he's had to work through some very large transactions in a very tough environment. So Phil, do you want to spend a couple of minutes just talking us through what you've had to do before we go through the execution spread section?
Yeah, sure. So Liberty Global, telecommunications company, theoretically global, but at the moment our reach is really just European. In the last 6 months, we announced a merger of our UK operations with Telefonica to create Virgin Media O2, which hopefully will complete next year. That was announced in early May. The company will have around £11 billion of combined revenue. That led to transactions for debt raising. We did £5 billion of refi in June. We did a £6 billion debt raise in September, and also FX hedging relating to the net proceeds that we're expecting from that. On top of that, we doubled down further with a transaction in August that we announced our intended acquisition of Sunrise Communications in Switzerland for a cost of around 5 billion Swiss francs. So the FX and the debt raising and hedging associated with that all fell within the last couple of months.
Great. Well, congrats, Phil, because it's a lot to get done in a tough environment. Okay, so execution spreads have clearly been wider in the last few months. There's been 3 drivers of that. First of all, it's clearly been a very volatile environment, and liquidity dried up pretty quickly as a result of, 1, people not knowing where the market was going, and 2, traders working from home and having less risk appetite. And then thirdly, clearly credit concerns led to CDS markets blowing out, and that led to wider credit spreads. So just put a few numbers on that. So sterling dollar and euro dollar spreads were about 3 times wider. For euro sterling, it's about 6 times wider. Option volatility was up to 10 times wider for just on the spread. In rates markets, it was even bigger almost. In the 1 to 12 months rates markets for forwards, it could be up to 50 times wider bid offers at some points, just because it's hard to remember now, but at one point we didn't know what central bank was going to do 1 hour to the next. And then in credit markets, the crossover was about 3.5 times wider at one point. And for some single names, it was even bigger than that. And then on the bank side, which is obviously relevant for funding trades like Rob and Tim were talking through, banks were about 4 times wider. So there was a real double whammy, which is leading to those kind of costs that Rob was talking through. And things have clearly stabilized since then and got a decent amount better, but credit indices are still 1.5 to 2 times wider than they were before. And there's also the credit active bid, which has meant that there's a very high number of corporates that are now on negative outlook. And within that, there's a decent number that are at risk of moving from investment grade to non-investment grade. And just to give you an example, a 5-year cross-currency swap for a BB plus name could see a credit charge double what it would be for a BBB flat. So it's a real big economic difference as a result of that. So what did we see corporates do as a result? As Tim mentioned at the start, initially there was less activity and slower activity, partly because of business uncertainty, but also we had a number of corporates trying to see how they could navigate through these higher charges, as Rob's talked through, and seeing how best to avoid them. But then in terms of what they actually did after then, we had, for larger transactions, such as, say, cross-currency swaps on the back of bonds, which needed to be done at the time, more pre-hedging, more splitting of trades into much smaller chunks, and having less banks involved to avoid information leakage. We've also seen an increasing trend of using mandatory breaks. And those have typically been in the cases where if a corporate doesn't think the trade might be on for the whole term of the trade, but they need it as a hedge, then they don't want to pay an elevated credit charge if they're going to have to take it off, and potentially have to pay a funding cost to take it off. So mandatory break can be quite an efficient way of managing those risks, and we've seen an increase in usage. And finally, on the tenor point, Tim talked about a shortening of trades. Since then, we've probably seen a bit of a reversal of that, and some corporates have looked to avoid having to roll short dated positions frequently, one because the market could dry up again, one because they don't have to pay an increased spread more frequently. So some monthly positions have become quarterly, 6 monthly, and even out to 12 months. So that's what we've seen and felt, but Phil, we're really keen to hear from you how you've navigated through it and what your experiences were.
Yeah, sure. Look, I'd echo a lot of your observations. Firstly, on the execution side, I think what the feedback that we were having from banks when we were talking about large executions, the sort of thing where a trader would normally be warehousing that over a period of hours or even days. Traders were working from home for the first time. They really didn't know when their access might get cut off. So that operational risk meant that they wanted to keep their books flat. Their appetite to retain that sort of warehouse risk in the book was much lower. So it was a case of execution spreads for that widening. And even in some cases where we saw that warehousing appetite just was significantly lower than what we had observed previously. I think on the credit side, the funding, so dealing with in the money and out of the money trades, I think there was an element of what was happening to the market in terms of the credit indices widening, banks not knowing, as you said, whether or not they would have access to short-term liquidity, the commercial paper markets finding themselves in difficult situations. But you've also then got an overlay that because senior management capability or capacity within banks was narrower, there was a strict prioritization of trades we observed. So you've got all of those sort of quantifiable components of the cost of a trade increasing, but also there was a lot less ability for banks to take on sub-hurdle trades or trades that were maybe non-standard in one way or another. And we found that we looked at we do have a back book policy. A lot of it is focused on the credit risk that we bear to banks. So when there was that 10% move in 2 weeks in sterling, we found that our swap book moved by something in the region of £750 million in the money to us, and that's £750 million more of credit risk to banks. So our policy is written, it says, look at resetting the mark to market, taking liquidity out. And we just found that the approach between banks, where in the past, in sort of more normal times, is relatively clear. There's a lot of emphasis on customer satisfaction and making sure the client gets what they need at the right time. In these sorts of times, it really varied from one bank to another, depending on what their operational capabilities were at that time. In terms of our own decision making within that, I think for us, there's still a very strong element that whilst as a Treasury team, it's really important that we make sure our execution is done in the most efficient way possible, and execution cost widening is counter to that. It still isn't hugely material to our broader strategy. Take sterling interest rates, for instance. When we looked at our strategy in relation to that in sort of March, April time, you're still looking at a 60 basis point move since the start of the year, give or take. So in that context, is the widening of charges by half a basis point or 1 basis point material in terms of your strategy? Not really. So in terms of the decision making at a strategic level, it doesn't really make a difference. Once you've then established that strategy, implementation of that needs to take into account the wider execution costs. I think for us, as Rob alluded to, the most important thing is to go back to Treasury policy and say, right, is it fit for purpose? And we did that and found that it was still fit for purpose. We didn't have any of the challenges that ABF had, because the telecoms business has been relatively stable in the context of COVID. Hasn't had any of those major impacts in terms of changes in the business model in that short space of time. So making sure it was fit for purpose was an important thing, and then the decision making followed from that. At least for our day-to-day stuff, the sort of M&A side was a little different, and I think that's worth spending a little bit of time on.
Great.
So on the sort of sorry, go on.
No, go on. So please.
No, I was going to say that on the M&A side, clearly these are much bigger amounts. That our M&A hedging dominates our FX activity in a year, and really, so the decision making on that is always case by case. So there, a Treasury policy doesn't necessarily apply in the same way.
Understood. We've just had the poll results in, Phil, which I'm not sure if you can see as well, but so the question was around transparency of charges, and you talked about how it was maybe a bit less relationship driven for some banks at the time. It seems as though there's quite an even split between how transparent people found, but broadly, more than 50% felt like it was as transparent as they would have wanted. Do you think that's a fair reflection for what you found?
Yeah, I would agree with that. It wasn't so much a loss of transparency, just a disparity of approaches taken by banks to whether or not they wanted to sort of really make it feel like business as usual, as it were. We were being treated more as these are exceptional times, so therefore which trades are acceptable and which trades are harder to push through is sort of reflected in the dialogue that we had.
Yeah, okay, well that's good. We've actually had another question that came through, which is, and it's not really on this topic, but the to it. So someone said a lot has been discussed around being reactive and downside mitigation. Do you have any thoughts on proactivity and opportunities that have arisen on the FX side, and so how have you kind of gone about that?
Yeah, sure. So look, I think a lot of the first, as I said, the first thing to do was to make sure the ways in which we are proactive through the policy is still fit for purpose, and we found that was the case. There were some things where we chose to be reactive. For us, what we did on the M&A transactions was very much consistent with what we've done previously, and we actually started by looking at our precedents and saying, what would we have done? What have we done in prior deals? and we tried to maintain a proactive approach through the whole process in the way that we would have done with any deal. Now, I think where we found that a little difficult was that our senior leaders, who normally we would have relatively expansive discussions on currency hedging, actually they were being drawn in all sorts of different directions in terms of making sure the business was still operating. So to a certain extent, we didn't have as much engagement as previous deals, which meant that we just had to simplify the decisions as much as possible, and really make sure that we're making those decisions as easy as possible in the context of the volatile markets. So I don't know to what extent that answers the question, but I think I do feel that where we've been proactive in the past, we were able to remain proactive. And there were a few scenarios in which we were reactive, but I don't think reactivity can be avoided completely.
I think I've just got a question for you there, Phil. I've got a question for you there, Philip. On this sort of idea of sort of senior engagement, I think it's pretty fair to say that throughout sort of COVID, we saw greater interaction from senior management on BAU decisions being taken around risk management. By the sounds of it, for you, that wasn't the case?
On what I will call BAU, so day to day.
Well, or transactional for you.
We carried on. Transaction, we still had the same. I would say we still had the same level of engagement when it came to the decisions. But I think where normally we discuss it over the lead up to the transaction, the Virgin Media transaction, for instance, which was early May. We were working on that for a good few months prior, and we'd expect the currency discussions to be ongoing throughout that period. Actually, those discussions all got compressed. So maybe the same level of engagement and all, but it got compressed into a much shorter time frame because in the early stages of the deal, senior leaders were engaged across sort of crisis management across the whole organisation, let's say.
Yeah, it's interesting. I mean, I guess the themes that sort of bore out from us as both banks and kind of corporates started to work from home. I mean, we saw a lot more bilateral trades executed, especially for larger and longer dated ones, both to access expertise of trading desks, but also to remain as anonymous as possible in the market while trying to clear them. And I think that, as I said, for FX, we did see greater focus of senior management on sort of the BAU FX. And I think that probably bears out in what Rob was saying earlier in terms of maybe a more rigorous view on short-term cash flow forecasting, but also on the existing hedge book. I think, Rob, do you think throughout sort of maybe if you felt that there was, I guess, more focus from senior management in what was happening day to day than previously?
Yeah, there probably was for ABF, but I think it was really driven by two things. But one was obviously the impact of COVID on Primark, which obviously had a very, very significant impact. And then secondly, we're about to go into literally, as you went into lockdown, we were in the process of preparing our half-yearly results, and our half-yearly results hadn't been impacted by COVID, so the first half of the year. But it's that forward-looking statement that one has to make around going concern that was particularly exercising the minds of the board and making sure that we could be able to provide clear foresight as far as the investor community was concerned, and it was really in relation to that and making sure that we were really understanding all of the nuances of the impact of COVID on all of our businesses across the different sectors in which we're operating in the different jurisdictions. And it was really that complexity that made it quite challenging. But actually, I think the board was very, very focused, and I think to your point, Tim, probably even more so than normal in relation to things like currency exposures.
Yeah, and I think that the other way that we saw corporates sort of bear out actions around FX was there's a kind of a clear technology angle to this as well. I mean, for the last decade, we've seen a kind of a move to multi-dealer platforms. And I think for the first time in a long time, we've seen greater demand to have single dealer platforms set up as a backup if price aggregators are disrupted. I think that We also saw algos and orders continue to be used mainly so that corporates can access the internal liquidity of banks. But I think, as I said, by far and away, that the greatest trends that we saw as kind of corporate shifted to moving from home was customers looking to trade directly with banks where they can access the liquidity and the expertise of the traders involved. And I think that's certainly our experience working together for your hedges. Mark, should I hand over back to you for any Q&A and a wrap up?
Sure. Great. So thanks very much to everybody. I think that was a really interesting and interactful conversation that we've had there. Some of the key takeaways from me, I found it really interesting. Rob was saying around the way in which they managed their bank charges by putting on the offsetting trades. I think that was a nuance I hadn't been aware of myself. The fact that ABF used the shorter term horizon and essentially learned through the crisis in order to better understand their exposures and how they were evolving over time. I thought that was a very helpful insight. And then what I picked up through it, both from Rob and from Phil, was around this. I guess a kind of dichotomy around should you have a more streamlined decision-making process and allow the people that are executing hedging trades to take decisions in order to be proactive or to manage the hedge portfolio, or do you really need to refer back up to senior management in order that they can take the decisions that they feel are going to significantly influence the business? And a discussion that I quite often have with our customers is, what is the philosophy behind your FX risk management policy? What is it that your Treasury is tasked to do with managing their FX risk? Is it to protect margins? Is it to ensure cash flow stability? Because once you have that clear understanding from the top down as to what that philosophy is and what the purpose of your FX hedging policy is, then it becomes a lot easier in times that we've seen through COVID of heightened uncertainty to make sure that everybody knows what that philosophy is and therefore what their job is and how they are empowered to exercise that philosophy in their risk management processes. So overall, a really interesting conversation, and thanks very much in particular to Rob and to Phil for sharing their experiences. So before we sign off, I would just like to highlight a couple of admin points. First of all, can I ask the audience to please complete the session survey located on at the foot of your screen next to the Q&A box. As I mentioned up front, the session has been recorded and will be available to review on the event platform. You can also continue to chat with fellow attendees in the networking lounge after this event. Please visit the virtual exhibition hall for information on this and other matters that are being discussed. Please get involved in further live and on-demand sessions that remain across the course of today and tomorrow. You can join the ACT's LinkedIn groups and follow on Twitter at ACT Update and tweet using hashtag ACTAC20. So finally, thank you very much again to our guest speakers, Phil and Rob, and also to Tim and Luke. Thank you very much for your attendance. Enjoy your day.